Hey everybody, happy Boxing Day for those of you out there in the United Kingdom or Australia. It has been 11 days now and Bitcoin has flatlined, zero volume, zero volatility, in fact record-breaking volatility. It's not much going on, but there is a lot of other top questions that are top of mind for you all. So hope you all had a good Christmas yesterday and are enjoying Boxing Day today wherever you are, and hope some people saw the Sydney Hobart start this morning. What a crazy good time. So let's just jump in. And am I sharing the right camera and stuff? I think so. Yes, let's go. And disclaimer, of course, this is just numbers and edutainment, nothing else. I am not your financial advisor, and where to ask questions. These questions come from the Patreon community. So jump in there, give it a whirl. And all I ask is if you learn something new today, hit the like. And if you haven't subscribed, do that too as well. So it'll be fun. So the first question, here we go. I am planning to hold assets long term and they are currently at unrealized loss. Is it worth realizing the loss and repurchasing the assets? For example, 10 sol at $50. Should I sell these now, claim a tax loss, and repurchase 10 sol again at $13? The answer to that is pretty simple. But first of all, I'm not a tax accountant, which should be pretty obvious. But it's the beauty we still have within the world of crypto in the United States. And I don't know how it is. There are some countries in the world that don't actually have capital gains on crypto. But here you can see it's real simple. Yes, Julie buys $1,000 of crypto. Crypto falls to $500. Julie sells her crypto and then immediately buys it back. And Julie claims a $500 of capital losses. This is possible in the United States. But there's one little caveat I'd like to walk you through, and that is this. The IRS specifically states that wash sale rules only apply to securities, and cryptocurrencies are considered property right now, not securities as defined by the IRS guidance. This means that as of now, it's likely the wash sale rule does not apply to cryptocurrencies. But if, this is the point here, and I don't know the answer to this, if all of a sudden cryptos are deemed securities, that changes everything and takes this wash sale off the table. But yes, do it. I'm planning on doing it too. So next question. This is from Bitcoin Plankton. I have a chunk of money in GBTC for some time, and I'm considering Tesla and MicroStrategy to be a safer, but probably also a faster horse, considering dumping it and splitting into these two. Thoughts? So I think about this stuff all the time, every day, not necessarily GBTC, but swapping other assets, and I've done some of that actually last week. But here, let's look at the GBTC discount first. You can see we're down at 45.72%. It's gone up a little bit. It did hit 49, so it is hopefully on the rebound. And a lot of the reason for this is that potential 20% share buyback to alleviate the pressure on this huge discount for the Grayscale group. But let's look at another simple analysis, and I'll share with you some numbers and some thoughts, and then you can make your own decision. So first of all, if we look at the all-time high for these different assets, Bitcoin 69,000, MicroStrategy 1,034, it did go higher, but we're just taking that number as the kind of daily close. GBTC 57, Tesla $403. Now the price now is 16,837. MicroStrategy is 163. GBTC is $8.33. It did fall under $8 for the first time in a very, very, very long time. And Tesla, $123.15. So I like to look at the gain that you would get back if it went back to all-time high. So Bitcoin would be a 4x, MicroStrategy would be a 6.3x, GBTC would be a 6.8x, and Tesla would be a 3.3x. The question is, and I ask myself this all the time, thank you, Dog One, is what will get back first? What will move first? So I think kind of my minimum price for Tesla end like a year from now, like Christmas, December 2023, will be about 270. Now it's at 123. The question is, how fast will crypto recover? And that could be a lot longer. So even if we just go back half to all-time high, you got a 2x on Bitcoin, a 3x on MicroStrategy, a 3.4x on GBTC, and a 1.6x on Tesla. Not that attractive, but I do believe the faster horse over the medium term will probably be Tesla, and because of earnings and fundamentals. I think it's going to take a little bit more time for people to get confidence in crypto. But then again, some people are out there like Tim Draper sharing some very, very aggressive forecasts. We don't know where this will all go, but I do know that GBTC will not get back to that all-time high for a very long time. For that to happen, Bitcoin would have to be north of $100,000. So take those numbers, run your expected values, and sometimes it's easy to make some money faster and then move to something that hasn't moved yet over time. And that's kind of my plan as we go forward. Next question is from Farid K. You describe your portfolio as a three-legged stool consisting of equities, crypto, and real estate. If you had to swap the real estate leg for another asset class, maybe something more liquid, what would you swap it for? So this is another thing I debate back in my time. And I did actually consider selling real estate back in early 2020, and I didn't do it. But I do believe, and it may not appear that way right now, but I do believe disruption will shape markets for the next 10 years. And I'm not the only one as well. But what is disruption? And I'm going to hear some groans, but I do see 5 S-curves all hitting at the same time. You've heard these before. You heard them again, but this is where the big money will be made. And many of these names that are leaders in this space, they're not in bubble territory anymore. So we have artificial intelligence, and the leaders there, you could argue, are Google and Microsoft, depending on the day. You have energy storage, Tesla, robotics, Tesla, genome sequencing, maybe Illumina, and blockchain. Well, you know where they're thinking about blockchains, but a lot of these are colliding, all happening at the same time. That's why I'm personally very, very excited for the future. If I had to get rid of real estate, I would invest in at least, well, I'm already invested in these spaces, but I do believe they will do well, despite what we've seen happen in the year 2022. And one of the things as well, and I'm going to bring in Jeff Booth here for a second. We did a video, well, it must be a year ago now at this stage, and he talks about Fold 34 and how exponentiality will change our understanding of how the world works. We're already seeing exponentiality happen, disruption happen on a small level, even in things like crypto, even in AI advances, etc. And that's just going to explode. I don't know if it's going to explode over the next 24 months or 5 years or 8 years or 10 years, but it's going to have a huge impact. And this is the time where it's very, very important to position ourselves and not fret about things like Elon Musk taking over Twitter and causing a lot of consternation. But be in positions that will take advantage of all these S-curves hitting at the same time for this exponential future, or as Jeff would say, exponential future of abundance as we go forward. So that would be my non-financial advice. Get a piece of disruption. Next question is from Coding Monkey. Looking at the P to E ratio for Amazon and Google, Amazon is around 80 and Google is under 20. What other factors would one look at to determine if Amazon is worth a buy, even though its P to E ratio is so much higher? Well, this is a good question, and a couple of things to consider. Let's just pull up some numbers before we jump in. So I pulled in the PE ratio for the different years ending, for example, December 31st, 2022, for both Amazon and Google. And you will see here that Amazon, yes, their PE ratio is about minus 924, but that's because they had a huge write-down from Rivian, which is a big part of their holdings. And that is a big problem. So that number is a little bit misleading. If we go out to 2023 year end, the PE should be more like 46. But all these numbers assume that the market cap stays where it is today, right now, at $869 billion for Amazon and $1.15 billion for Google. Now you can see that the Google PE ratio is far lower, 18.5, 17.2, 14.8, 12.6, and 10.9 out to 2026. But again, that assumes the market cap stays constant. If you assume the PE goes back to, say, 20, you can also assume the stock will double in that time frame. And that's the more important way to look at it. But I think when you look at a complex company like Amazon, you need to deconstruct all of the components. One, it's a huge logistics company. Two, it's an AI company. Three, it has AWS, and I think AWS is easily by itself worth probably close to $1 trillion. And that's the entire market cap of the company. And then they got the retail business, the advertising business, so many different components that have value. And they're just beginning, after all the infrastructure investment they've made, beginning to turn on the screws and be much more ruthless as well around where they invest. Maybe less into Alexa, maybe more into other areas of the business like advertising and, of course, AWS as they go forward. And that is kind of the play for the future. Now, another way to view the PEs, I just threw this as a graph together. You can see Google is not priced as rich as Amazon. And that is interesting because Google, I actually prefer as a company because of their AI and their search and things like YouTube that we are on now. But not saying that Amazon doesn't have a whole bunch of compelling values too, but I think the values that Google brings to the table are underappreciated right now in the market, just like Tesla's very much underappreciated. But even looking at the Amazon PEs, they are far higher on average than Google and will be considered so over time as we go forward, even though I do believe that Google has a much brighter future. So that's just my take. I hope that helps. Next question is from Anderson W. And I heard several theories on real estate. The 18.6 year cycle, the 2.9-ish year cycles. I talk about that a lot. The 10-year oscillating cycle. The oscillating model seems to have predicted the 2010, 2011 bottom and the 2021 top, the oscillating being the 10-year. This indicator is calling for another bottom around 2029 and the next top around 2038 to 2040. Are they all correct or all wrong? So it's funny, I never really believed in cycles till I started seeing patterns. And one of the patterns I did see was, and we'll talk about it in a minute, but let's go back in time. Let's go back to the 1800s. And big thank you to Nick for sharing this with me. And this is one I've seen before, but never gave much credence to it. But let's go back in history. This is what they call the Mth Cycle. And he goes all the way back. It was put together, I think, in 1875. And the idea is this zones A, B, and C. And you can see the cyclical pattern that happens with a lot of regularity, typically in 9 to 11 years between the cycles as we go forward. And at the top, you have a greater expanse, which is nearly the 18, 20, 21 years, depending on the year you were in. Now, according to this, if these patterns work, you could say that 2023 is a year of hard times, low prices, and a good time to buy stocks. Corner lots being one of my preferred pieces of real estate. I like to buy buildings on corners, goods, etc., and hold till the boom reaches the years of good times, then unload. So if this is correct, 2023 is the time to load up. The time to offload would be either 2026 or the greater cycle, maybe all the way out to 2035 or back to 2032. It's hard to say, but I do believe you can find ways of making a narrative fit many of these charts. Let's look at another one. Let's look at the 18-year real estate cycle. And this is the one you referred to, and it's a chart I pulled up. Now, if you did rely on this 18-year real estate cycle, which held pretty tight in the past, up until about, let me see, the low missed by about a year or so in, what was that, 1998? 2007 was pretty tight. It was actually, the bottom didn't fall out of the market until about 2009. And then for the rally we had recently, driven by pandemic changes and cycles and buying behavior, and people want to live more in their homes and not go to offices, you would have missed out on a lot of opportunity. So from that perspective, be careful. If you do believe too much in these cycles, they can lead you astray. And of course, there's cycles that have been around for a long time. They're not going to work. Another way of looking at it as well is, since we're on the topic of real estate, the case Shiller, which is my preferred indicator, and I've been looking at this a lot, and you can pull this up in your trading view, etc. But here you have the top to bottom, or bottom to top of a cycle back between 1991 and about 2005, 2006. It was 15 years. Then the global financial crisis, 2009, to the top, about 13 years. So there's no real pattern, but depending on where you measure from, there's also a ton of mini cycles in there. So there was a great set of gains between 2002 and 2006, for example, and many others. And you don't have to be on the train all the time, but it is also very easy to see when real estate is very oversold versus overbought. And also when you tie it back to things like money supply and interest rates and other macro factors, I think they all have a huge part in what's happening right now. And you've seen the real estate market being destroyed all over the world. Australia, Germany, United Kingdom, United States smashed because of increasing interest rates. And it's a double whammy, especially for people who are not all cash buyers. Now, there is one other cycle I want to insert here, Anderson W. And this is what I call the 62-month cycle. And here, again, as I mentioned, you can find a way of fitting most data to any cycle. But with this, it's kind of interesting. This blue line here shows you the actual return of the S&P 500. We're no longer talking about real estate right now. After inflation and when dividends are reinvested. And you can see here each monthly data point, and this is adjusted for inflation. This nails bottoms, for example, June 2022, and it is monthly data. Now, and just playing with these things, there's a whole bunch of charts that I look at, but this one was kind of interesting, and that 62 months is 5.2 years, 5-year cycle. So again, but this one has been uncanny. And also remember, there can be mini cycles within bigger cycles, but this is much nicer. But if you talk about, say, a 5-year cycle and a 10-year cycle and an 18-year cycle, which is nearly like 4 or 5-year cycles, it all ties together. And there's always that lag between the stock market and real estate too. Stock market falls first, real estate falls after. So you just need to shove your chart over a little bit. So that is my set of thoughts and cycles. I love the questions, and you'll always find one that fits. But be careful of the whole cognitive bias as we go forward. Again, you got to look at a lot of external factors to determine exactly what brings these things down. So, for example, this may predict the future, but if something were to happen, like a nuclear warhead going off, all bets are out the window. Let's talk about this one from Tipmaster. Welcome, Tipmaster. Thoughts on the new spec minable coin called Kaspa. I am a miner, primarily Bitcoin, formerly ETH, and people have been touting this coin as a post-ETH wonder. Can you review and provide insight to determine if it's worth mining? So this is when I step out and say, some of what I'm going to say may be offensive, but again, it's just numbers. So don't shoot the messenger here. When I'm asked a question, I'll look at numbers and I'll make a determination based on that. So let's look at the Kaspa Mining. And this one applies. There's a lot of people out there with GPU miners that they can no longer use from Ethereum, and they're looking for alternatives. The question is Kaspa an alternative? And remember, I'm not a miner. So we'll see what happens. But there's a couple of things that I've pulled out from this chart here. And it's only going back to July 2022. Number one is the black line, which is the hash rate difficulty. It's the difficulty has actually flatlined. I'm not sure exactly, but that is a little bit concerning. Not only that, the network hash rate has kind of gone up and then down a little bit. And the other thing is the average reward given is very, very low. So again, you're in the mining business to get rewards, and this doesn't look as good as it was a few months ago. And we'll talk about other things from a few months ago as well. Let's look at some of the hardware. Most GPUs, I can only find 3 that would make money with an electricity cost of about 12 cents per kilowatt hour. So here you can see all the top ones that typically people would have, your NVIDIA RTX 3080, GTX 1080 Ti, etc., all lose money. You can't make money mining Kaspa with these assets. The only one I could find was the best one, is the AMD RX 6700 XT. It runs at 395, whatever that is, mega hash per second. And you can make a profit of 12 cents potentially on this one. But let's dig more into the profitability of different GPUs. And let's look at what you could potentially make from this. It is not that impressive. If you look at the typical 1 month profit for good hardware, you could make 87 cents per GPU, and that is not very good. Your reward would be 175 CAS income, 87 cents after a lot of work and labor. A lot of people look at mining and they can calculate the cost of electricity and their hardware, etc. But people often don't take into account the cost of their time. If you assume you should be worth maybe at least $20 an hour and you're working on your mining rigs for 10 hours a week, that's a huge part of money that you are losing when you could be allocating your time somewhere else. And probably the most concerning to me of all is this piece. This is the supply. And obviously, if you are mining for an asset like a token, and this is not a good situation here. So Kaspa supply, if you go back to July 2022, only 6 months ago, you can see they had a self-reported circulating supply, which is a red flag. And it was 8.57 billion Kaspa with a max supply of 28.376 billion. Now the max supply has gone up a little bit to 28.7. I don't know why. Max supply should always be a max. And the circulating supply is 15.44 billion. And that's 54% allocated. Remember, this supply has doubled over the last 6 months, 100% inflation, which means a huge amount of price suppression on the token, which can be seen in the chart. But remember as well, you also have to overlay the price chart of what happened since Ethereum moved to proof of stake. A lot of people are finding things to do with the GPU miners, and they probably flooded into this called Kaspa proof of work mining place with their GPU miners. So that's all I have to say on the subject, but I don't see a way of generating decent passive income from this particular miner. But again, please let me know in the comments below if I'm missing something here. But you need to have a truckload of miners, thousands and thousands of them, to generate enough to pay your rent and fuel your car, etc. And next question, this is from Joe1. Other than my home, which is paid off, I don't want to deal with the 3 T's, tenants, toilets, and termites. I also don't trust paper asset stocks. I strictly believe in hard assets. Does that leave me only 2 choices for investing? That is Bitcoin and precious metals? Interesting question. And the 3 T's made me laugh, by the way, because I've experienced all of them many, many times. So first of all, let's look at the list of hard assets, the so-called best hard assets in my opinion. But they're all very risky. So let's run down through them. So first of all, real estate, you said you don't want this. Second, gold, silver, platinum, palladium, who knows what. It sounds like yes, interesting. Then you have resources. You could, play the game in resources, commodities like oil, natural gas, pork bellies, who knows what. Again, it's a riskier game, but it's good to play at bottoms, like back in March, April 2020, oil was like at 0. Great time to buy oil futures or something. Then you have equipment and machinery. This one is an interesting one. If you can find a way to, I'll zoom out for this one. A good friend of mine has a whole bunch of vending machines that he deploys at shopping malls. Little things like kids' rides and other stuff like that. This guy makes a fortune, works with about 5 malls. So think about equipment or machinery, things you can deploy to generate passive income if you don't mind holding them around and servicing them, etc. Very, very interesting. I know another guy that has poker machines that he deploys in taverns and restaurants back in Europe. So interesting ways. That's kind of the category of equipment and machinery. Then you have your vehicles and classic cars. This one is interesting, especially during C19. We saw the price of, classic cars explode 2x, 3x, 5x. What you could have purchased an old 911 Turbo for 30, 40 grand. All of a sudden it's trading for 6 digits. Then you've got your paintings and you've got other collectibles. So these are some other examples, but find what you're most familiar with. And again, it's very risky. And let me talk about some of the volatility risk. A lot of people talk about watches, and beware of this. So for example, this is a Rolex chronograph, and it went from 15,000 to over $100,000, back to $50,000. Now it's trading about $40,000 because apparently Rolex can't overcome their supply chain problems. There's another Rolex as well, the Oyster Perpetuals with different colorful dials. They were trading back in early 2020 for about 5,000. Then they went up to 18,000. Then they went back to 14,000 in summer 2022, and now they're 11,000. Still double the original price, but the volatility is insane. So make sure you know your assets and you can brace for volatility. And who knows when things like Rolexes will be hot again. I wouldn't advise buying them now, but buy things that are maybe good perpetual income generating, especially the ones I mentioned, like the machinery. Don't discount machinery that you can deploy, service that generates perpetual income too. So with that, it's favorite part of the show. Thank you all, everybody. This is Chitra, is a feisty bear and a great digger. She is enjoying retirement in a sanctuary and can be found sleeping in her homemade mud pits to keep cool. So a big thank you as well, everybody, for that. Let's jump into some live Q&A questions from you all, and I hope you're enjoying the Boxing Day that is. Juju John, Bitcoin is plan B, crypto is plan C. Now a full coiner. Woohoo! I'm really struggling to save a deposit for a rental property as there are so many bargains in stocks and crypto. Any tips? I think, again, think about the timing of stuff. And that's why I love pairs. We talked a bit about pairs today. Imagine, hypothetically, Tesla rebounds first. They have blowout earnings in Q4, and they roadmap, and then they launch Cybertruck, and the stock buyback. I mean, this thing will go from 125 to 270 very, very quickly. And there's not many other assets that can double like that. But what we all have to get better at, including myself, is timing those swaps to be able to, jump on one train and let it run, and then jump on another train that hasn't run yet, but is about to run, etc. Now, getting back to your big question regarding rental properties, you have your whole coin. Don't touch that. Keep that. That's part of what I call a hodl bag. Being a whole coin in the future will be a very special place to be. But rental markets, rental real estate typically lags in single family homes, which typically lags the stock market a lot. So the stock market will rebound first. Then until rates or mortgages substantially come down, there's going to be a lot more pain in the multifamily rental real estate business as we go forward. But the pain will be hit first in the single family homes, then rentals as we go forward. So I don't want to say speculate with down payment on a real estate, but things are just many things right now, as you say, are bargains. I mean, ridiculous bargains that we have not seen for a very, very long time. Mab79, can you discuss the NFT projects leaving Solana? So there's a lot of, there's interesting things happening in the cryptoverse right now. And it's kind of what I call pay to play. And I don't, just with one thought, and I could be wrong on this at all, but there's a lot of chains that are looking to buy books of business so they can show that they have more traffic on their chain. Because at the end of the day, I keep on talking about the importance of daily active users and breadth of dApps, etc. And this is very, very important. But I also believe whatever chain is the best, cheapest, and fastest with the nicest user experience, that will be the one that wins the day and gets adopted the most. With real world applications, whatever they may be, that is probably the most critical thing that you have to look for. What really has value. And NFTs, yes, they're great for retail people to come into crypto, but it's not the be all and end all of a chain. And we all know that Solana has been hurt right now, but they still have one of the most impressive roadmaps. But that's all I'll say on the subject. Next question is from Zulfikar Ali. Will Elon be selling more stock? He has a habit of saying one thing and doing another. Very true. We have learned, he said, I'll never sell again. Sells again. Never sell again. Sells again. But this is a different situation. And this is a kind of a perfect storm of pain he's been in. First of all, he made an offer for Twitter. Way overpaid. and it was going to be funded, about a third of it, with his stock, and then investors would kind of pick up the rest. I could be off on those exact numbers. The problem is, because of all the shenanigans of Twitter, it brought the Tesla price down, and also the FUD around lack of demand, etc., etc. So that brought him into kind of margin call territory. And he's shrewd. He's very good at playing the long game and allocating capital, not only for his businesses, but also for his debts to pay for things like Twitter. I do believe he has a dry powder sandbag. He kind of hinted at that in a recent Twitter space. And that's why he sold the last amount. But he did commit to not selling to 20. One of the things is a bit concerning. He said to 2015, then he said for the next 18 months to 24 months. But everybody needs kind of to cover the cash burn, but I don't see him dumping as much as he had to in the past, unless something really, really bad happens. And he did mention that. He said stock markets are very strange, and he's very upset with the fact that the Fed are just smashing the economy as well for everybody. So that's where I think if he does sell more after saying what he said, he would destroy his credibility. And I'm hoping he doesn't do that too. So, but we don't know. None of us can tell what the future is. But I do know that, again, the roadmap is like no other company. The margins is like no other company. The way they manufacture is like no other company. Their energy business is going to start getting turned on. Like, you know, to get a Tesla Powerwall, you couldn't get it over the last year. You'd be able to get them in 2023, and they're extremely high margin products. So we're going to see Tesla, people realizing this is going to be one of my little predictions for 2023 is the penny will drop where people see, oh, Tesla's not a car maker after all. It's an energy company. It's an AI company. It's a manufacturing prowess company. And that's kind of going to be interesting. And I'm completely unshaken with my conviction in actual Tesla. And a big thank you as well for your super sticker, Dog1, Green Candle, Kiwi Robin, Min Win. This is from Min. Is Solana still good? Another channel was saying developers are moving to other layer ones. So I did cover that in a video a few weeks back. It was a survey of about 200 developers from Solana. 71% of them committed to staying with the chain. And again, developers will go to where the most opportunity and where it's easiest to develop because they are allocating their capital, which is their time, to a chain. So there's lots of FUD out there. It's nonstop FUD all over the world. As Raul Paul says, everybody's throwing poop at each other. And that's just the nature of the beast. These are times when you just look at data, huddle down, ignore all of the stuff out there. There was somebody recently said that Tesla's going to $25. And what did I think? I think it was a question from Git because I think Miles Deutscher said it. And technically, everything's possible. In 2019, Tesla was at $17.50. In March, it did wick down to $25 or $30 as far as I can recall. So who knows where things can go. But if you are an investor and you're investing in disruption and margin and the future value of an asset based on earnings potential, I can't find one better out there right now, other than maybe Aramco that pumps oil out of the ground. But anyway, and a big thank you as well, long-term holder. I hope your travels are almost coming to an end and you're coming back home soon safe. And to your family too. And 2112 Working Man, happy holidays. Stay well. Yes, stay well, everybody. And Sin City Crypto. Big fans from Sin City Crypto. A few legit channels out there. Thank you, Sin City. I wonder where that is. Is that Vegas Crypto, or is it some other place, or is it a virtual land? We don't know anymore. But I want to thank you all. I hope you all learned something from this. Be safe out there. Future is very, very bright going back to these S-curves. And again, this is the world that we're going into. And this is the most exciting time to be alive when all of these things are hitting at the same time. So let's go, everybody. Hang tough. Thank you all for being here. Happy Boxing Day.